I think the market is well overvalued. I think it is delusional. And as far as the housing markets, there's a lot of trouble here. We're looking at a potential repeat of 2008. I think oil is going to the mid 50s. I have no interest in buying it. I'm still short. We're seeing some bottoming action in the gold markets, as well as seeing some bottoming action in the grain markets. So I think this is all good for the commodity space. An equity sell-off will help benefit commodities. Gold got extremely oversold. The actual low point that I could see gold going to next, if it goes down again, would be like...
Our next guest shorted oil a couple weeks ago. He's been shorting oil since a few months ago. That trade turned out to be exactly correct. Now, what is he going to do? What is he doing with gold now that it's rebounding from $4,000 an ounce? And what is he doing with the S&P 500? Up a little bit today on Friday, June 26th, but trading near 7,300 points. Should we be concerned about Fed rate hikes? Should we see a return to 2022 collapses of stocks, gold, and bonds when the Fed starts raising rates later this year, if they will? Well, let's find out. Todd Bubba Horwitz joins us once more. He's the chief strategist at BubbaTrading.com. And we're going to be talking about whether or not the Fed's going to be raising rates this year and when they're going to be raising rates. Right now on Kalshi, traders are predicting that there's a 56% chance that we're going to get a rate hike before 2027. Now, the CME Fed Watch tool is predicting pretty much an 80% to 90% chance, depending on when you look at it, that we're going to get at least one rate hike before the end of the year. So what does Bubba think? This video is sponsored by Kalshi. It's the largest prediction market in the United States. Unlike a sportsbook, you're trading peer-to-peer on real-world events, from economic data to political outcomes, and the price moves based on public opinion, not a house. Go to the link in the description down below or scan the QR code here to get started. And new users who use my code LIN, L-I-N, can get $10 when you trade $10. And going back to the next Fed rate hike trade, right now, if you put $50 down on a rate hike before 2027 and you turn out to be correct, your payout could be up to $84. Stay tuned for what Bubba thinks is going to happen this year. Bubba, good to see you again. Welcome back.
Great to be with you, David. Always a pleasure.
You know, people have been talking about this recent slide from Bitcoin, gold, Bitcoin extending its losses from several months ago, gold extending its losses from a couple of months ago as well. And the stock market rolled over ever since the beginning of June. Now, you're short the stock market, but you just got long gold. Let's talk about that first. Why long gold at $4,000? You told me offline.
Well, I thought 4,000 was a real solid level to get in. If you look at a chart, it's a solid level. Big hole numbers are solid. And again, we're down, over 25% since the highs. At some point, I'm going to draw a line in the sand and say, okay, I'm going to trade this. Now, again, if it breaks harder, I'll take my losses and move on. But I thought that was a pretty good spot. And it should create some new interest. Plus the fact that you are now seeing we've digested the Kevin Warsh meeting, which is the interest rates are going higher, not lower, which is not good for gold as a rule. But we've already priced that into the market. I think the equities are showing you that there's some trouble here brewing. Yes, they're a little bit higher today, except the NASDAQ is still down 120. They've made a very nice rally from this morning when the NASDAQ was down 500. The S&P was down 60. So we've had a nice solid rally from there. But overall, if you look at the chart, you see that we're making lower highs on a regular basis and lower lows as we head down. So you combine that as gold being now considered, it's always been considered by many a safe haven asset. So you take the bad news out of gold that really is already priced in, and now some of the bad news from the markets, and that should buoy the price of gold a little bit. And I think we got a nice solid run up to, 44, 4,500, and then we'll reevaluate the position.
Inflation news came out. Now, the PCE, the Fed's preferred inflation measure, hit a 3-year high earlier this week. PCE, excluding food and energy, so core PCE, rose at 3.4%. Now, the headline inflation rate was already at 4.1%. And this is tremendous pressure on the Federal Reserve. From the one hand, the president has been wanting to lower interest rates for quite some time. Now I'm reading an article from CNBC that says, well, Trump is easing off pressure on Kevin Warsh this week as inflation came out. So this dance between Trump and the Fed seems to be a little more harmonious this week. Ultimately, though, Trump wants lower interest rates because that's better for real estate and it's better for stocks probably. All right, what do you want? As somebody
I
living
want
in
higher
Las
rates.
Vegas, yeah.
I'm sorry. I want higher rates, and I think they're going higher. I think the days of the low interest rate, the printing more money, the bailing out the banks, all that stuff really has been. Although the stock market has performed well, you have to look at the average consumer. The consumer is struggling. You have the K-shaped economy, so you've got those issues to come with. Interest rates, really, if you would just let them trade freely, David, and let the free market determine what they are, the 10-year notes are now just under 5%. They were almost at 5%. I think they're going to end up nearer 6% by the end of the year. But when you look at the bigger picture, credit card debt is so deep, which is a big high number of interest rate. Over 14% of the people are 90 days past due. You've got a situation that the peer-to-peer lenders, the Prospers, the Cabbage, their average rate is in the 12s and 13s, which tells you that the free market can handle higher rates. Higher rates are actually better for the economy because we're not creating wealth artificially for the wealthy. We're bringing in the entire population. And as far as the housing markets, there's a lot of trouble here. We're looking at a potential repeat of 2008. Now, I don't know about the rest of the country, but I do know about here in Las Vegas. We're back to stated income, no doc loans, and 0% down. Now, we know how that worked out last time, and it's not going to work out anybody this time. But what it's really telling you is that the housing inventory is so overextended, they can't sell them. And if they can't sell them, how are they going to get their money back? So they're being forced to make a lot more bad loans once again. And unfortunately, for me, the taxpayer, that could be a crisis because certainly if we do collapse again, which I believe we will, they'll come back to the taxpayer and bail out the banks once again.
Speaking of bailouts, have you been reading the news that in BC, British Columbia, where I live in Canada, the federal government wants to bail out a few condo developers? So what's been happening is there's empty condos sitting in the city. And because there's a bit of a bubble burst right now going on in the metropolitan cities of Canada, Toronto and Montreal, to a certain extent Montreal, but mostly Vancouver and Toronto, now the government wants to bail these companies out by buying these empty units and using them for so-called affordable housing. You can read up on this later. So instead of letting the market correct, what the government's going to do is buy them and then use them for, I guess, more affordable rent. Is that something that you think would work?
I don't think it'll work. I think they may do it, but I don't think it's a good idea. Again, Canada's obviously more of a socialist country, but if you're in a true capitalist society, you have to let businesses that are failing fail and let new business come in and take its place. This is the big argument that we continue to have. That's the unfortunate, the Keynesian socialist view, which is why there's really no need for a Federal Reserve. The Bitcoin market, the crypto markets have shown you that the free markets can work freely without any government intervention. And when the government gets involved, it's never any good. And the biggest who hurt people are hurt the most are the taxpayers when the government gets involved. Because remember, government doesn't make money, government makes debt. And the taxpayers are responsible for the debt. I think they have to let these places go out of business and let new business come in and take their place. I don't see any way. I don't want to bail out any builders, certainly. I don't want to bail out the banks. I didn't want to bail them out in 2008. I don't want to bail them out the next time they go bust. This is the problem when you allow companies to get too big. We can already see what's going on with the private credit industry, which got so big and now is in very, very big trouble. So we have a lot of these standings that continue to show up of problems. Yes, the equity markets are still holding up, but remember, it doesn't take long for that direction to change. And we've seen some pretty extensive moves. Even Wednesday afternoon, you saw the NASDAQ was down 400, and then Micron's earnings came out right at the bell, and the NASDAQ turned up and rallied 700 points in less than 2 minutes. To me, that's telling you that the tops of these markets are in, and you're getting some of this crazy volatility at the end of the day. But overall, we keep making lower highs, and that would indicate to me that we're going lower, and that would coordinate with what they're doing in British Columbia, with the housing problems in Florida, Texas, Nevada. Arizona. Those are all four states in this country that are having housing bubbles right now.
By the way, you said you're short the S&P. Let's talk about that. The stock market and the gold prices have been moving pretty much in lockstep over the last couple of months. Now, they don't always move together. In the past, they've moved in opposite directions. That just happens to be the case in the last couple of months. Are you not concerned that if you're long gold, gold may fall alongside stocks if you think stocks are going to fall?
No, I don't think it's that. I think, again, the correlation of the assets, both have gone up in history on a year-over-year basis, right? On an average, year-over-year, they've both gone up, and I think that will continue. But I think that the stock market has not priced in the news as bad as it is, and as bad as I think it is, and as bad as the economy is, where I think the gold markets have already accounted for the higher interest rates and the other problems that would be typically a problem in the gold market. Those, I think, have been priced in based on the 30% haircut. So for the equities to catch up, we would need a 30 to 40% haircut there as well, which is what I'm expecting.
So why is it that the gold market is a better discounting mechanism than stocks right now for all these things you talked about?
Well, I mean, listen, the gold market's going to be certainly benefits from inflation. Okay, so that's something. People want hard assets. They need someplace to go when they finally decide to pull the trigger and get out of the equity market. And again, we're starting to see those types of things happen. So again, it's if you want to throw the dollar into that range as well, typically the higher dollar would create some weakness in gold and in commodities. And I think that's starting to go away as well. There's accepting the higher price of the dollar. Remember, asset classes tend to price things in before they actually happen. And once they happen, that asset is either made a high or a low. And that's what I think we've seen here.
When a person doesn't want to reflect or behave according to reality, we call that person delusional. When the stock market doesn't want to behave or react according to reality, that's called being undervalued or overvalued. So right now, which is it? Overvalued, undervalued, delusional, or just pretty accurate?
I think the market is well overvalued. I think it is delusional. Okay. But again, the one thing you have to remember about markets is you can't fight them. I mean, the markets are built on the buyers and the sellers. That's what makes the markets go up and down. They're automatic. They're electronic. They don't have, it's not my opinion that matters. What matters is what the price action is. And the price action suggests that we're seeing some very topping type of action in the in the equity markets. We're seeing some bottoming action in the gold markets, as well as seeing some bottoming action in the grain markets. So I think this is all good for the commodity space. An equity sell-off will help benefit commodities, but certainly stocks are extremely overvalued. We just saw, you and I talked right before SpaceX came out, and I told you that if it spiked up too far, we would be a seller of it. And of course, it did spike up too far. Now it's back to where it actually opened up initially. So again, markets have a way of finding out when they've gotten too expensive, and this market's been too expensive for quite a while. Again, I'm not predicting it's going down today or tomorrow, but at some point we're going to see this sell off, and we're going to see it pretty healthy. And don't be surprised when it happens, because it's going to happen.
So here's the heat map of what's going on today. Yes, the overall S&P 500 is slightly up, but it looks like investors are rotating away from the high beta tech names and moving into more defensive. So we have here Eli Lilly up about 6%, Johnson & Johnson up more than 3%, AbbVie up more than 2%, NVIDIA and other semiconductor shares down today. So that entire sector is down, but that hasn't brought up the entire index, interestingly. So if you had to be in the S&P right now, would you favor a specific sector over others?
I certainly would want to be a seller of tech here right now. I want to be a seller of stocks like NVIDIA and things like that, because I think that those really were overvalued. And you've already seen the lesser known names that had those big gigantic rallies early have already got cut in half. Okay. If not 50 or 60%. So that to me is those usually lead the way to the next direction. And we're now starting to see that money come out. And you've seen obviously NVIDIA under pressure. You saw Apple take a pretty sharp hit yesterday, rallying a little bit today. But overall, again, these markets will determine. But look what happened to Palantir. Palantir got down to 106, okay, before coming back. Look at what happened to SpaceX. Went to 240, and now it's back to 155. So once again, these are signs that are telling you that markets are much overvalued, and they're certainly going to the first sectors they picked on were some of the Dow sectors. So now the Dow is a little bit stronger because when you look at the picture, the Dow is considered a little bit of a safer index. And if we go back to 2008, the Dow was actually at that time in 2009, when we actually bottomed, the Dow had more value than the S&P on a futures price. Okay. Now the S&P is about $40,000 over the Dow. So that's starting to balance back the other way. And that's what I would expect to see happen. I think they'll both go down, but I think the S&P will accelerate at a faster rate to the downside.
I want to point to you something that has popped up a couple of times on my radar, the Dow-to-Gold ratio. Now, I wonder if you think this will revert to where it was in history. So if you look at this chart going back to before, close to the early turn of the century, you'll see that the average historical mean was somewhere around 5, the Dow-to-Gold ratio. Currently, it's at 10. Now, in extreme cases, when gold went to all-time highs in 1980, as well as in 2011, the Dow-to-Gold ratio collapsed. At its lowest point, it was 1. Do you think it could ever go back to 1, or is that just a one-time anomaly that happened once in a century?
I mean, it could be. Could it happen? Yes. Will it happen? Probably not. We'll probably go and retrace back to somewhere towards the mean, which would tie into my long gold, short Dow basically theory here. I think we will see that. Again, those numbers over time. Yes, we see some irrational behavior to the upside or the downside on those ratios. But normally, when they get to an average, and you know what the average is, it's like the average gain in the markets are 8.5% year over year. That's what they've been forever. Yeah, we've had years that were down 30% and years that were up 40%. But at the end, if you have to smooth it out, if you're an investor, you have to smooth out and understand what the lifetime averages are, not what's happening over the last week. If you're a trader, different story.
Okay. How are you trading the Fed funds rate here? This is from Kalshi. It's a prediction market. Next Fed rate hike. Before 2027, traders are predicting a 56% chance. Before July 2027, which is next year, 65% chance. Actually, if you look at the CME Fed Watch tool, traders there are predicting pretty much 100% chance, 80% chance we're going to get at least one hike before the end of the year. What do you think is reasonable if you think any hikes are coming at all, Bubba?
I think we get at least one, maybe two before the year's over. I think that they're warranted. I think that they're due. I think that, again, Warsh basically pointed out, I mean, he didn't get into real detail, but they're definitely hawkish. And again, you have you mentioned the PCE, you mentioned the inflation, and inflation is not getting better. Even with this big significant drop in the crude oil market, inflation has not come in all that much. So I think that, again, you have to have rate cuts. Unfortunately, Ben Bernanke was the original guy who screwed up this entire program and got us into the mess that we're in, and really created the K-shaped economy that we have now, with all the bailouts, with all the BS, with everything that they did. So now here we are. They've got to get back to some true normalcy and get away from the ridiculous economy, which, again, you've only got, let's say, I'll give it the benefit, 10% of the population is doing well. The bottom 90 is not doing well. So I think there's definitely going to be rate hikes. Yes, it'll be painful for some at the beginning, but it should bring back some normalcy and get away from these crazy home building, this overbuilding, this trying to day trade your houses type of environment. And of course, I think the banks are in trouble as well. And I think they're going to need to raise some capital, which higher interest rates will help them raise some capital to have more on deposit.
Okay, let me show you this chart now. I remember I spoke to you in 2022. People were worried about what happened in 2022. That's the last time we had Fed rate hikes, and the S&P went down about 30% that year. Okay. What were you trading exactly in 2022? Do you remember?
Yeah, I was short.
Okay.
I mean, remember, again, I have to clarify that so everybody understands. I'm always net long, no matter what's going on in the market. I'm always net long and hedged. Okay. So that's virtually a neutral position that has a risk, let's say, of 5 or 6%. Okay. I'm never getting out of that. But from a trading standpoint, I'm definitely, when you see a chart like you're showing here, I'm always trading that chart to the short side. Okay. And just recently have I switched over from trading to the long side to trading to the short side in the market. And that's what we're seeing now. In fact, as you and I have been talking, the S&P just went negative again on the day. So we'll see how it all ends up in trades. But overall, I think there's a lot more pressure and a lot more sellers are going to show up.
I mean, it's not here. It pretty much lined up with the first rate hike. I think the S&P front ran it a little bit. But more or less, the stock market start dropping as soon as the Fed starts raising rates is a pattern we saw in the last hiking cycle. Can we expect the same this time?
Yeah, I think so. Again, that takes away the ability to borrow money. All of a sudden, even margin costs now at your brokerage, margin rates are very expensive now. Back then they were cheaper, but again, the margin rate starts to price out taking bigger positions. So it does create more selling. So I think that will definitely create more selling once the announcement is made. Now, we're already pricing it in, but I think the official news, and again, there's a lot that can happen. We've got midterms coming up, which is normally between now and midterms, the markets are lower anyways. You throw a rate hike in there, you could see some pretty serious selling.
Okay, let's talk about oil now. You were short oil last time I had you on the show a couple weeks ago and the month prior. Are you still short oil today? It's gone down a lot. So that short position turned out to be absolutely spot on. Congratulations. I wonder if you're buying at $70.
No, I don't think, I think oil's going to the mid 50s. I have no interest in buying it. I'm still short. I'm certainly, I have a level in which I will cover and reshort. Again, I don't see, I think that we have a glut. There's way too much oil. There's a very bad economy. The demand is way down and we keep producing. So to me, the only one who benefited from this crisis in Iran is the oil companies who are reporting record profits. The consumer got creamed on this whole deal. And I think oil now is headed much further south. And like I said, I'm expecting the mid 50s. Before this move is all done.
I'm curious how a trader like yourself factors in the Strait of Hormuz when deciding whether or not to short or long oil at this point. The Strait of Hormuz right now technically is still closed. They reopened for about 4 days and then it closed again. And now people are worried about another choke point, basically what we had in the last 3 months. I wonder why the oil market basically didn't go back up to 100 or 90 immediately after the reclosed immediately after they reclosed the Strait of Hormuz. Didn't move.
Well, first of all, let's look at it from a reality standpoint. Number one, the first rally up to 120 was a joke. I mean, it was just pure panic and it caught everybody short. So they trapped everybody. And if you look, every time there's been an issue in Iran, we're still making lower highs. Okay. This today may be a blow off to the downside, but we're trading WTI in this country. WTI oil has no effect in the Straits. Okay. It has an effect here. Brent oil is what gets affected in the Straits. So again, they made a big deal out of something that isn't that big of a deal, other than for us to have the ability to export back. And there's obviously a lot of tankers here coming to get oil and try to take it back. But again, you have no demand. You have an enormous amount of inventory. You have an enormous glut of oil in this country. So, and we'll see. And of course, I don't know if you're aware or not, but starting July 24th, there's 2 new contracts coming out, crude oil and gold, that are going to be trading 24/7.
Okay. You don't buy Donald Trump and a few other analysts on Wall Street as well, claiming that we're going to have an oil tanker shortage by as early as July 4th.
I don't buy any of the news. And trust me, the markets are much smarter than what everybody else says. Okay. Mm-hmm. The markets are telling you that crude is headed lower until it's not. And again, today could be the final blow off to the downside for a while. That I can't say. But certainly the markets are much more efficient and much smarter than politicians, than traders, than anybody else. Anybody who tries to outguess or outsmart the market is not going to make any money as a trader.
So let's talk about key levels then for the assets we talked about. So you're saying WTI has further room to go down potentially you're looking at the mid 50s. What about for gold? You went long at 4,000 rather. Right now it's had a bit of a bounce since 4,000. I wonder why you don't think it's going much lower. So if you take a look at 2001, for example, it went down from its top. It went down 45% from its peak in 1980. Went down about 70%. I know times are different. Gold's already down. Yeah, go ahead.
We went down 30% from our highs already, right? We were at 5,500. We went down to under 4,000. So we went down 30% already.
Yeah.
Okay. And now listen, I'm not saying that, listen, I own gold. I own physical gold. This is a trade. As a trader, I made at 4,000. And if it breaks 3,800, I'll get out and look for another entry point. I'm not saying that it's a great guarantee, but I think there's a great shot that we see 4,500 on this next up leg, if not higher. Okay, but I will start to look at 4,500 as a place to potentially lighten up my position, or certainly will be tightening up my stop and locking in a profit should I get there. I mean, I may lock up before the day is over, at least no worse than a break-even trade. But at the end of the day, I could certainly see a rally here. Gold got extremely oversold, and that's one of the things you have to look at when you look at the standard deviations of a market. There are so many places, you get to a point that you go so low. I mean, the actual low point that I could see gold going to next, if it goes down again, would be like 38.16 would be something that I would be looking at. Okay,
yeah, all right. And on the SPX, we got 7,300 points right now. What are you looking at for levels?
All right, well, I'm going to give you levels based on the S&P, the ES, the mini ES, because that's what I trade. Okay. Yeah. I think it's got a great chance to go down to 7,200. I think the highs are in. I think the next resistance would be at 75.20 would be where would be reselling and adding onto my position.
All right. What do you think of the dollar? We haven't talked about the dollar in detail yet, but it's been catching a bit all year. If you look at it from a year to date basis, DXY is up 6%. Now, with the Federal Reserve potentially raising rates and the other central banks around the world already raising rates, the ECB and the Bank of Japan already did that. I wonder how the dollar will react to rate hikes later this year.
Well, I think that, again, here we get into something a little bit tricky, David. The dollar is still the reserve currency. As much as we want to talk about BRICS and all the other nonsense that goes on, the dollar is a reserve currency. Countries buy dollars when they are concerned, when there is problems. There's a lot of problems in China, and they're buying dollars. Okay, there's a lot of problems in a lot of areas. They're buying dollars, which is propelling the dollar to be higher. The dollar is considered a very much of a safe haven play. And I'm not talking about for the individual investor. I'm talking about for nations and for countries that accumulate dollars in these times. And I think that has been what has been pushing up the dollar, is the safety effect of countries buying dollars, which keeps pushing them higher because they're concerned about their own general economies and where they are coming from. And again, you can name a number of countries that are in a lot of trouble right now that are probably buying dollars.
Yeah. And this probably explains why gold moved the way that it did. If you overlay the dollar chart with the gold chart, you can see when the dollar tanked late January, that's when gold spiked. And then vice versa, when the dollar recovered. It's interesting how, if you take a look at the last 3 months since the start of the Iran war, when the Iran war broke out, the dollar kept rising, probably due to reasons like you just stated, and gold went down. How do you explain that?
Well, again, I think when you look at a chart, if I look at that chart and I look at, gold being the blue level there, well, you can see the spike up was so ridiculously high, okay, that we get too carried away. I mean, that the problem is that the emotions and the fear of missing out or the panic in traders gets too great. So the sell-off was way too big, and everybody was so excited, and gold's going to 10,000. I got to get in. I got to buy. Well, guess what? Same thing with silver that went to 120. Now, reality comes in, and they start selling. So now you get the sell-off, and the sell-off goes much deeper than it should have gone. But because of the fear of missing out, now the panic selling comes in, and then you tie into margin calls. When the equities start to go down, margin calls. So people start to look for assets to sell. Well, where's there some of their profit? In the gold market. So they want to protect their crappy equities that they're holding and sell into the gold market. But that was my signal to say, hey, this is about the spot where we should see a bounce. And that's what I continue to see. And I would continue to see a spot. And I would also look at, the Dixie doesn't trade enough for me to want to get involved with it. But if I were going to trade the Dixie, I would sell it. Here,
I would just look at this chart and say to myself, next time we have a war happening anywhere in the world, or breakout in the Middle East or anywhere else in the world, God forbid, why don't I just load up on dollar and dollar equivalent assets and sell my gold just based on what happened here? Is that too simplistic an evaluation, you think?
I think it's too simplistic is right. I think it depends on where we are, where you're coming from. Remember, we were coming from very low levels in the dollar at the time. And we were coming from very high levels of gold at the time. Just out of natural trading, forget about news, looking at those two charts, you would have considered being a seller of gold anyways up at 5,500. Again, I'm going back as a trader and a potential buyer of the dollar at that low level either way. So again, you have to look at the overall action of the market itself and see where do we stand when that happens, and then make that decision. It's never that simple because a lot of things get priced in far beyond that. When you finally see it hit the news, it's already priced into the tape of the market or the chart of the market.
Finally, I see you're wearing a 1776 shirt ahead of July 4th. So happy 4th of July in advance. I probably won't see you ahead of time, so I'll say happy 4th of July now. What do you think, sorry, let me rephrase that question. What would you want the economy to change if, let's say, look, you want America to get better, you want everybody in America to have higher living standards. What do you think needs to change in our economy for that to happen? Or what would you like to see?
Well, I mean, obviously AI is a big problem in this country. And listen, AI is obviously the future. It's obviously a great technology, but it's costing Americans a lot of money, costing Americans a lot of jobs. I think if you could ask me what I could do in 250th anniversary, I'd get rid of the Fed, number one. Okay. I would end the Fed. I think that the free market will much better off tell you where asset classes should be priced. I think this benefit of the cheaper money didn't benefit the population. It benefited the wealthy, there's nothing wrong with that, except the fact that when you shut the rest of the population out of investing because they can't borrow money like you can. I mean, think about it. When you could borrow money at 2% and you're going to get an 8% return on the market, why wouldn't you make that arbitrage? I'd like to see the ending of the Fed. I'd like to see the ending of government being able to inside trade, because I think that is a lot of problems to the market as well. I would like to see term limits put in on all offices. Okay, not just the president. And I'd like to see some other drastic changes, but that we can cover on another day.
Okay, perfect. Thanks very much, Bubba. We appreciate your time. Tell us where we can follow you.
Go to go.bubbatrading.com. That's my new website, go.bubbatrading.com. And you can always email me with any questions at bubba@bubbatrading.com. And a lot of people like the book. So if anybody wants my books, I'll be happy to send them out a PDF. You just email me at bubba@bubbatrading.com.
Okay, well, I hope you have a great 4th of July week. Are you taking any time off, Bubba?
No, sir. Well, I mean, I'll take the days that are closed. I have to go to Chicago and do some moving around. So I'll be working there while the markets are closed.
That's a real patriot right there, embracing the American spirit of working. Good. Thank you very much, Bubba.
Thanks, David.
And thank you for watching. Don't forget to like and subscribe and use my code LIN, L-I-N, when you sign up to Kalshi. Remember, new users who use my code can get $10 when you trade $10. Link in the description down below or scan the QR code here.